Hello everyone and welcome to the IndexUniverse Spotlight Series. My name is Ugo Egbunike, Senior ETF Specialist here at IndexUniverse. Today I'm joined by Martin Kremenstein, the America's Head of Passive Asset Management at Deutsche Asset Wealth Management. Martin, thanks for joining me on today's show.
Thanks for having me here.
So let's go a bit into the expansive suite of currency-hedged ETF products that you have. You guys have been out for a little bit over a year now, I believe?
Yeah, we launched our products actually in June of 2011.
Okay.
So we've got a good couple of years of track record now. The idea behind the product really came from 2009 when the equity department at Deutsche was talking to the FX department about what equity investors had experienced in 2008. With the sharp pullback, there was a strengthening of the dollar. And it became clear that investors would need some kind of product that managed out the currency exposure on their international equity investments. Because prior to that, they'd all been just using unhedged products, which during a dollar decline year was great, but if the dollar was to strengthen, there's a significant headwind to returns. Around that time, MSCI was also marketing their suite of currency-hedged indices. It was basically indices that track their benchmark equity indices, international ones, but then hedged out the currency exposure using FX forwards. So we worked with them, and in June 2011, we brought out 5 currency-hedged international equity products tracking their major benchmark indices. EFA, emerging markets, Brazil, Germany, and Japan.
So Japan, great for, thank you for mentioning it, but that's been sort of the poster child for the currency hedge strategy. Do you see any other regions or countries that might also benefit, or investors might benefit from implementing the same strategy in their portfolios?
Sure, Japan's been a standout trade this year. I think hedging out the currency has added another 10% or so to your returns versus an unhedged Japanese equity exposure. But I think currency hedging actually has a place in all international equity investments. The fact of the matter is, when you invest internationally, when you buy a foreign equity, you're not just taking a position in that equity, you're also going short the US dollar and long that foreign currency. And so as long as the US dollar is in a declining mode, as it was from 2001 to 2011, when the majority of internationalization of the kind of US investor base was going on, it was a one-way street. However, over the last couple of years, certainly this year, in a strengthening dollar environment, having that unhedged position can actually be quite painful. So we think, on a single country basis, we think Germany is a very interesting trade, simply because, Germany is the motor of European growth. It's poised to do very well once Europe comes out of their downturn. As global growth picks up, Germany, a big exporter, should do well. But the euro is predicted by most currency strategists to decline to anywhere between 110 and 115 on the dollar. And so, if you invest in Germany and you haven't hedged out your currency exposure, then you are going to have a lot of headwinds to really positively benefiting from that position. Brazil, equally big exporting nation. Brazilian companies should do well from a declining real. But in general, you should always look to when you're looking at international equities, you should start, looking at whether or not you want to have a hedged or unhedged position from the very beginning.
So it sounds like you're arguing for a currency hedge strategy to be the default for an international investor?
I think the default position should be perhaps 50% hedged, 50% unhedged.
Okay.
So you want to take a position in an international market, whether it's emerging or it's EFA or it's a single country. You should start by saying, right, I will take the position at 50-50. Now, if I have a bias towards a declining dollar, well, then I move all of my exposure to unhedged international equities. If I have a bias towards a strengthening dollar, then I should move all of my position to a hedged international equity product. If, however, I don't have a view on currency, and remember, a lot of retail investors and small investors don't have a view, then you should stick with 50-50, because then you are neutral as to what the dollar does or what the foreign currencies will do.
Switching gears for a second. As an ETF issuer, I know that you guys are quite familiar with some of the notions and misnomers or misnotions that people have regarding ETF liquidity. What is Deutsche doing on its side to educate investors and then to reach out to buy-side investors looking to get into your funds?
ETF liquidity is a very important issue, and I think one of the biggest misconceptions out there is that the volume that you see on the screen, the printed trades for the last day, week, month, really show the full amount of liquidity that's available to an investor through the creation-redemption mechanism. The liquidity of an ETF is theoretically limited by that of the underlying market. The rule of thumb is the liquidity of an ETF is the liquidity of the least liquid equity in the underlying basket. But there is definitely that kind of that mid space between the 100 lot trade, very easy to do, the $100 million trade, equally easy to do. It's that in between where the size may not be that of a full creation unit, where the investor needs to actually get a market maker to take risk, is where, I think investors can get hurt. And so, we do a lot of things. We educate investors about how to trade ETFs. We also have a capital markets team whose job it is to make sure spreads are tight, make sure size is offered for investors, to make sure they can execute in and out of the fund in as efficient manner as possible. And all ETF issuers do it because it's in our interest to do that. And so we're no different in that respect.
Martin, if you don't mind, could you go over the tickers of the product suite?
Absolutely. So the DBX Tracker's currency hedged EFA product is DBEF. The currency hedged emerging market product is DBEM. Japan is DBJP. Germany is DBGR. And Brazil is DBBR.
Well, thank you very much for joining me on today's show, Martin.
Thank you.
Folks, there you have it. It's the DBX Tracker's product suite. For more information, visit www.dbxus.com. That'll be it for today's show. Tune in next time.